Australian Wealth Builders, helping time-poor executives build financial independence through property investing.
Thank you very much for joining us. Cam McLellan here. I'm here with my good friend and business partner, Matt Lewison. Louis, how are you?
Good, Cam. Good to be here again.
Yeah, it's fantastic. I'm very glad to see the back end of 2020. I think everyone can applaud that consensus.
Yeah, absolutely. Although it's been such a year of ups and downs, hasn't it? Like periods where the market was absolutely booming, then or running into a boom, then dying overnight, then running back into a boom. And I think we're finishing on a strong note.
Yeah, it was good. Even in the midst of, and you saw really strong bounce backs at the, after first lockdowns in Victoria, those sort of things when the market responded and auctions were in the thousands, which, a few years ago would be, considered a super Saturday in volume term. So you could see as soon as easing's restricted, the way the market went, then different parts of the country just fought back against the COVID pandemic regardless. The supply and demand factor was kicking in there and people could afford to buy property. And that's what I think everyone was mainly fearful for, throughout the period. If you can't afford property, then demand diminishes.
Yeah, absolutely. I guess it'll be interesting for people who are listening to this podcast in 2021 and beyond, while we're recording it at the end of 2020, it'll be interesting to see, I guess, how things play out in the new year, because there's a lot of pent-up demand in Victoria. We've had a pretty soft auction season, as in soft numbers of auctions this year. And there's still a heap of people who are queuing up ready to buy when more auctions start or when more properties start to come to market next year. And obviously other states are at different parts of the cycle. And it's kind of been a bit of a resetting of the cycle and the different positions that the various states are in since COVID this year. But there's some really positive signs, and I'm looking forward to looking back in a year's time and seeing whether, I guess, our predictions start to play out.
Yeah, I 100% agree with you. I think over the holidays, I've been working my kids pretty hard, and I think this is a great time to reset and for people to educate yourself. And I talked to the kids about, I've been working them, they've been packing, over 10,000 books to send out to, different people. So, people are still, and I was explaining to my kids the fundamentals of the book while they haven't read My For Your Other Property Investor or Investing the New Normal, which, we both worked on those books. We were going through the COVID period to bring that to light and give people clarity. But I was teaching the kids about the concept of being financially fit and keeping your mind fit. People, when they want to get physically fit, they go to the gym. When you want to get financially fit, school doesn't teach you that. So that's why I talked to them about the concept of the books and why I wrote the books. It gets people there. And we started talking about where money comes from and why investing in business owners have so much more advantage than someone working a job. So I actually got $100 and broke it down into $10 notes. And I said, all right, so you've worked for the day, you've earned $100. Then I took $50 away and I said, that's the government's, that's tax. It was just in the looks on their face, it was fantastic. So getting them used to the concept of where money comes from. And then I explained them the old analogy, which is used in a number of different books and formats over the years. I've heard it many times, is the concept of the donkey, the cart and the carrot. And obviously the way, the meaning of job is really you're just over broke. And the concept of that is you're just earning enough to get through that day. So the concept of most people working is they're a donkey following that single carrot to the end of the day. And the cart owner, takes them to market. They follow the carrot all the way there and takes them back and throws them the carrot and puts them back in the stall. And I was explaining the concept to the kids of going, well, when you get an investment property, first of all, the government doesn't take that money straight away. You can reduce your taxable income. So I explained to them about, the expenses for the property goes over there. And then you're taxed on what's left over. And they got that concept and saw the advantage of the taxation benefits of it. But then explaining to them going, well, imagine the cart is an investment property. Now, you don't even have to be the cart driver. You can own lots of carts and have lots of drivers and donkeys working for you. And that's the concept of investment properties or business. So you can start to see their, 10, 11 and 13-year-old minds starting to tick over. But those basic concepts, 99% of the population, while they can understand what I've just explained, they'll then go about and do the same thing they did last year and the year before and go to work and just chase that just over broke carrot week after week and don't take a small bit of that paycheck and put it into an asset which is going to grow in value. I think obviously that's why people are listening to the podcast going, I've got interest in property. I want to be investing smarter, doing it better and getting better outcomes. But I think people, especially this time of year, people need to really reset their mind and focus on getting himself financially fit by absorbing information, but then putting it into action, because the old saying, fortune doesn't favour the smart, it favours the bold. And so taking action is really the biggest step forward for most people. But hopefully, mate, I didn't riff on there. Just sort of give you a bit of an update on what I've been up to with the kids over the holiday anyway.
Sounds interesting. I would have thought that you'd use the one out of, there's a great book called My 4-Year-Old, The Property Investor. And in that book, the analogy is that money flows through the economy like a stream. And some people carry their bucket to the stream every day and fill it up and take it back to their hut and drink water for the rest of the day. And tomorrow they've got to go back to the stream. While other people take a cup and a shovel and they have enough to get by for the day, but they dig, and after a while, the stream comes to their door. And that's, I guess, what investing is about, isn't it? It's about creating something that's generating income forever. And while you do have to, at times, go without the big bucket on a daily basis, you take only what you need from your earnings because you want to invest the surplus of your time, I suppose, into making sure that you can have as big a stream as possible of income. And money comes into the economy, and it's probably a thing. If you go back years and years, sorry if I'm going to go real nerdy.
No, that's fine. Go for it, man.
You expect it now.
Economic history buff, I know you are.
Yeah, that's right. So if you went back hundreds of years, obviously for an economy to have more money, they had to basically find gold or stamp more money in coins and things like that, or create things. Whereas today, money is not created from finding gold. It's created from printing.
Yeah.
But they don't print it and put it straight into the economy. So if you have gold, that's equity. That's something you've created. It's a value. It's not a debt. Whereas today, money is created through the issue of debt. So the Reserve Bank says we want to have more money in the economy. So we're going to lower the interest rate so more banks come and borrow money off us.
Yeah.
And by borrowing money off us, we've put more money into circulation in the economy. They're going to go and lend that to other people who will probably either use it to build houses or lend it to other people again. And it creates a big pile of debt. So being smart about how we invest our money to create equity from that flow of money, and knowing that when interest rates go low, it means there's more money coming into the economy. That stream's really rushing down now.
Yeah.
And that's the best time to be starting to dig your channel and try and get it obviously going to your door, so that after a few years of hard work and smart investing, you're going to be on easy street without having to go take your bucket down to the stream every day.
Yeah. Now, I want to talk a little bit about some of the opportunities that come out during these times. Now, since we've been investing the last 20 years, I've seen lots of different stimulus packages and grants of different flavors, sizes, locations, limitations, timelines. So I don't want to get specific on what's in the market now or what's currently available. We can talk generally about it, but I don't want to get too hung up on it. I really want to talk more about first of all, I've purchased property every year for the last 20 years. So I haven't waited to purchase based on waiting for a specific grant to come along that suits me, because if you do that, the market moves and you miss out on the growth, which is more important. But talk us through some of the grants that you've seen over the years and the impact they have to markets and what's in play at the moment if people want to take advantage of them.
Yeah, I mean, we've had first home buyer grant, which has pretty much been in play for the last 20 odd years in some form. And I'm pretty sure that came about as a result of the GST being introduced.
Yeah, it's like 2000 or something like that, wasn't it?
Yeah, so governments wanted to obviously offset that and keep construction happening. So they introduced the first home buyer grant. Now, it's very hard to take away something that people come to expect, isn't it? So that's been around in some form or another. In the GFC, they boosted it. So they took the first home buyer grant and they increased the amount. They've changed it over time. They've said, all right, now it's no longer for houses over 750,000, or it's not for established houses. It's for new houses instead. In Western Australia, they've had government loan schemes where the government will co-invest with you in a property, which has been really well taken up. And then obviously we've got the home builder, we've got an additional building boost over in Western Australia in the last few months. But probably one of the bigger things, and if I just come back to our analogy of the stream, so what they're essentially doing with these things is trying to make it easier for you to dig your stream. They're starting the stream for you. So you'd be crazy when these opportunities are out there. If you're in a position to take them up and you don't, well, you're kind of creating more work for yourself. And I'm pretty sure your first property, you managed to get the first home buyer grant. Is that right?
Yeah, I did. And my girlfriend then, wife now, Felicity, she got took advantage of the first home buyers grant at that point in time.
Yeah. So Elle and I missed it by about 12 months, I think, unfortunately, when buying our first ones, but that's okay. So they're trying to make it easier for people to get into the market. And the reason that these things are structured in the way they are is that it creates jobs. We know that the building industry is it has a depth that no other industry in Australia has, because when somebody's building a house, they've got to buy the land. So there's a lot of work involved in bringing land to market and delivering a title lot. Then there's a lot of work in building the houses. There's a lot of suppliers. There's a lot of trades. Then there's white goods. There's all the other things, soft furnishings to complete it at the back end. So it brings into play so many other industries as well, that $1 invested in housing or $1 million invested in housing obviously makes its way right through the economy almost. So that's why they're investing in these things. Now, the other thing that they're trying to do, and we've seen more recently, so about 8 years ago, the ACT government started to play with stamp duty. Now, stamp duty is one of the biggest impediments to buying a house, and not just for buying a house, but also from moving houses. So they call it a really inefficient tax. Obviously came about back in the day where they had to literally stamp the plan and transfer titles and register the title on the plan. And in their records. So that cost them money, and they obviously wanted to recoup, or the government wanted to recoup the cost of those things from the people who were transferring the land. So it's always on the buyer. Now it's become a bit out of whack because it was set at around 5% of a property's value. So now that properties can sell for millions and millions of dollars, let's say something in Sydney that's around $1 million, which is about the median, the government's picking up $50,000 to register a name on the title.
Yeah.
And that's just exorbitant relative to what it was initially intended for. And it stops people from moving, because if you sell a house, you're going to be paying an agent's commission, which I guess is only is on a house of $1 to $1 million plus, you might be paying 1.5%. That's palatable. That's about $15,000. But then when you go and buy another house, you're now paying $50,000 to the government for writing your name on a piece of paper or on a register.
Yeah.
So it stops people from moving, and it stops people from moving for jobs. So that's one of the reasons why governments want to avoid that and want to start looking at ways to change, as well as it stopping people from entering into the property market. So the ACT government has started phasing out stamp duty in about 2012, I think it was, or they announced a plan back then, and they've just started to do it. It's happening over time. And then more recently, the New South Wales government has got on board with that as well. They've learned some things from Canberra, and what they're doing is slightly different in that they're giving people the option to either pay stamp duty or not pay stamp duty, which sounds great. But if you don't pay stamp duty on the purchase of a property, then for the rest of, I guess, whoever owns that property from then on will pay a land tax on that property, which will be a small percentage of the property's value. What that does, obviously, it reduces the upfront hurdle to get into the market. It does obviously have an offset, which is it creates an ongoing burden for you of some sort. It's not significant, but it means that the government over time will get to a point where they're making more money off everybody, as opposed to just making money out of the few people who are selling or
transacting.
And it means that their income is going to be less lumpy and smoother over time. Victoria, post-COVID, have introduced a discount for the next few years for people buying property, and it's 50% for a new property and 25% for an established property under a certain threshold. Again, these things might change, but what we're starting to see is a bit of a trend with state governments moving towards phasing out or reducing stamp duties, and they'll obviously want to make up for it through other means. And I expect all the states will be watching New South Wales to see how it plays out there. But obviously for property purchases, if you don't have to come up with an extra 5% to get into the market, let's say somebody might be borrowing 90% of the property value, so they've got to come up with 10% in terms of their deposit and equity to get into the property, plus they have to come up with another 5% to pay the government. That's 50% extra in terms of their savings amount.
Yeah.
So if they can eliminate that more broadly around the country, it's going to make it a lot easier for people to get into the market and to shift around as well, which is really positive for property prices. But it also means that if you're paying more land tax, then people aren't going to stay in properties they can't afford. Like we tend to find now in older suburbs, there's multi-million-dollar properties that older people will stay in because they don't want to have to sell the asset because it has an impact on their pension. If they're in a $5 million asset, but they've only got 200 grand in cash in the bank, they can get the pension. If they sell that $5 million asset, then they're no longer entitled to the pension. But obviously they're not going to stay there if they're paying a couple of $1,000s a year in land tax.
Yeah, and it's interesting that with the land tax being, it wasn't something that we considered when we purchased our current home 5 years ago. But I knew the amount was there. It didn't stop us purchasing it. But I tell you what, it was a bit of pill to swallow. We had to fork out.
The stamp duty, you mean?
The stamp duty. So with stamp duty, they're looking at some incentives now, halving it for new builds. Obviously, they want to get new builds happening at a faster rate because that stimulates the economy. Victoria's got that in play. Is that coming across other states? Do you know?
Not yet, no. So obviously Western Australia have got a building boost instead. So they're making a cash contribution rather than lowering the stamp duty obligation. Other states are looking at it, but there's been no major announcements.
I think you did the numbers for me for investing in the new normal when we wrote that book together. And I think it was glaringly obvious. So there's obviously additional benefit to this as all the trade. So when the government gives a stimulus package, I think you did the example of a $20,000 stimulus package, enables someone to purchase or get into a $750,000 home. It actually creates about $137,000 from memory in revenue for the government based on the stamp duty and the GST, and that's not taking into account all of the economic benefits that it has that runs through the economy.
Yeah, that's right. So if a small grant from the government helps somebody to get into the property market that otherwise would have sat out, then it obviously opens up the door for the stamp duties, the GST take, the tax on any profits that builders or developers have made through that, which total, as you said, about 137,000 on a 750 grand property, which is 6 times the 20 grand that the government offered in the first place.
Yeah.
And then, you've obviously got people who are making income that are going to be paying income tax off their earnings as well. So, it's a bit of a no-brainer, provided it's done at the right times, because probably the downside that I see in having a first home buyers grant that's just always there is that it gets to a point where it's expected and it's no longer something that's going to stimulate the economy. You have to come up with more stimulus to kind of keep throwing it in. And at a certain point, you run out of stimulus to throw at people because you go, geez, we're practically buying the whole house for you now.
Yeah, the stimulus becomes normal and you get used to it. Yeah. It's definitely directional where they're putting it. Obviously, directing people to new builds gets the economy going. And we saw that sort of stimulus had a major impact to the market when they brought that into play last year, when you saw titled stock just getting swooped off the table. There was nearly campouts in some areas through Brisbane. And I think we saw a 400% increase in land sales immediately overnight when they brought that in. So how's the stock situation at this point in time?
Look, it's still tight. There's a lot so they've obviously extended building boost and the people have got a bit more time to start building now in 2021. But it means that anything that's likely to get titled in the next 6 months is pretty hot in most states at the moment. So probably one thing I'll just comment on as well. So the building boost is great for generating activity and creating activity for building houses, which creates jobs, which improves confidence in the market. What building boosts won't do is increase the price of houses. So it obviously pushes up the price of land, but we need wage growth and other things that will push up the price of houses. So we've got lower interest rates. That's going to push up the price of houses in markets because it improves people's borrowing capacity. As I mentioned, do increasing wages or more confidence in the market. Things like stamp duty absolutely increases the price of all homes in the market, not just the blocks of land or the off-the-plan sales that'll benefit from a building boost. But some of those changes, which are obviously have more broader appeal because they're effective on all houses, not just new ones. They're much more stimulatory in terms of price growth. And that's the balancing act the government has to find between creating jobs and creating activity, because they also want house price growth. And it's something a lot of people perhaps don't realise, is that the government wants, and banks all want prices to go up. They don't want them to go up 20% a year.
Yeah.
They want them to go up at a steady rate so that it makes debt relative to the value of assets less and less.
Yeah.
And it improves confidence and creates what they call the wealth effect. When people are seeing their equity go up, they go and spend more money at the shops, they go on more holidays, and more money filters through the economy. So it's a really complex thing in the property market. And we obviously love looking at the markets and the drivers and all those sorts of things. I remember actually when we were in Sydney last year at one of our functions and one of a Q&A event, And one of the people in the audience asked me what would be the 3 things they should look for in the market because they love data.
Yeah.
It's very, very tough to pinpoint 3 things because it's so all of it interacts with each other. The jobs market, immigration, vacancy rates, how much construction's happening, government grants, all those interest rates. There's so many things interacting. But yeah, I guess that's what makes it very interesting.
Yeah, there's definitely not 3 magic darts that you throw at the board and go, now I've hit it. I know when we have our monthly economic reviews and, when your team's brought you all the data and we lay it out and present it to the exec team and we sit there and the question is, so what? So what does that mean? So what does that mean? And trying to take it all into account all at once and then dissect small parts of it is, I suppose that's, like you said, we love doing it. That's it's part of the joy of it. And what about other types of investment this year? Obviously, you've been working hard on Resi Fund. Talk us through that type of investment and why that's appealing to some people, especially at the back end of their investment journey.
Yeah, well, I mean, we've started to see in the last couple of months that certainly people at that transitioning to retirement phase of their investment journey have really started to come into Resi Fund. And one of the things that they really like about it, first of all, there's exceptionally low vacancy rates in most cities around Australia at the moment, not all, but most. And that's leading to rental growth and obviously really strong incomes. And Resi Fund's obviously a property portfolio designed around the way that we grew our property portfolio, where you buy, you add value, you rent out.
That's a good point. I should maybe just, if you don't mind, just explaining for listeners, what is Resi Fund and why do we create it, or why do we start working on it 5-6 years ago and bring it to life? Yeah,
so obviously we've helped thousands of people to buy their own investment property and start growing an investment property portfolio.
Yep.
And we really see housing and particularly investment property as the most reliable way that we can imagine to grow wealth. It certainly helped work for us and it's worked for so many of our clients as well. As many people as we've helped, there's probably 100 times more that we haven't been able to help because they couldn't get into the market and either couldn't get in or they're at a different phase of their journey where they didn't want to be taking on debt or their incomes were diminishing because they were gearing up for it or getting ready for retirement. They didn't want to be taking on debt that they might not be able to service if they were no longer working. So we kind of went to the drawing board and we said, well, how did we grow our wealth and what's the best, who's done it the best around the country and the world and what models did they use? And it was pretty much the same model as us, which was you buy land, you add value to it, you rent it out, and then you do it again. And because you're adding value, you're obviously creating equity, so you're manufacturing equity. And you're also then you're generating income, which means that it's a lot easier for you to acquire assets and to continue to acquire and add value than it is for somebody else who's out of the market. And a quick example, I mean, Harry Triguboff, who's the wealthiest property investor in Australia, through the GFC, I think he's in 2008, 2009, his wealth grew by about 20%. And he was already in the billions of dollars and he added another billion to it through a period where everybody else was seeing their wealth eroded, or many other people were. And he did that because he had thousands of people paying rent to him every week. And even when the GFC hit and office buildings were seeing vacancies rise, he still had people paying rent and it allowed him to go and buy more sites that he could develop. And he wasn't relying on selling because he was just going to rent them out. And then he sells in different parts of the market cycle. And again, that's something that we've done over the last 25 years. We'll add value, we'll hold for a long time, but we'll trade out of assets and move to another one, another location when it's appropriate for us to do so. But generally that's outside of 10 years, but also means that we pick up market cycles that others may not be agile enough to get into. So, I think that's pretty much it. So we created a fund that allowed other people to invest in alongside us. We were the first investors in it and we continue to invest in it. And now others can invest alongside us as it acquires new assets. Everybody gets a share of the rental income from those assets and of the capital growth out of the assets that we're adding value to.
Yeah, so you're not only getting the benefit of developing something and adding that manufactured equity and the uplift. The LVRs are kept quite low, so that there's good income distributions.
Yeah, so we go for high yielding assets to start with low gearing, which means there's lots of surplus cash flow, which goes through to investors in the form of distributions. And because it's low gearing, it's obviously not as volatile as other types of assets can be, and we get some benefit from the gearing. But I guess also having a very low bar for people to invest in. So people can invest from $1,000. We've got some investors with 350 grand in there as well. So it's a really good mix across there. And I guess it allows people to get in. They can have a regular savings plan. So instead of paying, I guess, money towards interest on a negatively geared property, they can be contributing to their equity through a regular savings plan and distribution reinvestment plan to get the compound growth effect. So, we've beat the market by about twice, or by a factor of 2 in 2020. So, been a good year for Resi Fund, even though the broader market was a little bit stagnant.
No, very good, very good. And while past performance is no indication of future performance, it's great to see that the fund's done well. So people can check it out, resifund.com.au. If people are keen to invest at this point in time, Louis, obviously we talk about the first thing you need to do is set your goals where you want to be at the end, obtaining a borrowing capacity. What are some of the steps people can take? So if they're thinking about 2021's the year for me, getting in before the upswing really takes hold, people need to get the borrowing capacity sorted out. What are some of the steps that they should be going through to get themselves mindset ready and investment ready? Yeah,
there's two. Let's break it down into two different groups. You've got people who have not yet entered the property market and they're trying to work out what they need to do to get into the market.
Yep.
And then you've got people who already own property, whether it's a principal place of residence or investment property, and they're not sure whether they can acquire another property. But if I go back to the first group, the people are looking to get in but not sure when or how, we've got a team who can assess a client's or somebody's earnings and savings and give feedback, not just on how much you could borrow today, but to get to, I guess, the ideal amount to buy a high-performing property, to give feedback on what your income might need to be to get there or what extra savings, start to give some tools on how to bridge the gap. And we've had some people coming through that have been really surprised at how they've been able to go from being, I guess, what they considered short of a deposit to within a few months, perhaps even getting to a point where they go, wow, I only needed to change 2 things, which I could do easily.
Yeah.
And now I'm able to buy a property. And that gets them into the market. And this next few years, while interest rates are low and the RBA has indicated they're going to stay low for longer, that's going to be a great time in the market. So you don't want to be sitting out, spending the next 2 years saving up if you can get in sooner. For those that are already in the market and have loans themselves, again, doing an assessment with a professional finance broker who actually understands investment to start with, because there's some amazing savings that are available. And like we're talking in the tens of thousands of dollars that can be saved on an annual basis for people with sort of 1 to 2 properties.
Yeah.
And that really opens a door to being able to duplicate, to get your next property sooner, not to mention just the benefit of paying less interest. And that's something we've always gone out of our way to regularly review our debt facilities, making sure that we're getting not just the cheapest rate, but a rate that's appropriate and has the flexibility to allow us to get into our next property sooner. And that's something that we didn't have brokers back in the day. We were doing it all ourselves, but we absolutely think there's a lot of value in speaking to a broker. If you've got one, go and talk to them. If you think that they're a professional investment mortgage broker, certainly, obviously we've got a team of professionals who do that day in and day out. That's what their job is.
Very different. Yeah, very different. But the difference between a standard broker who can help you out with your home loan and you feel like you've got a relationship with, they're going to be the biggest hindrance to your investment journey of anyone you're going to come across, because they don't understand investment finance, specifically the structuring of investment finance. So they might be able to cross-collateralize and lock your own home up with an investment property, but that's going to stop you getting investment property 2, 3, 4. So there's only really, I'd say, under 1% of brokers in Australia who understand investment finance and the way things should be structured. So if you know someone who's got a large portfolio and they use a specific broker who helps them with that portfolio, fantastic. If not, you can email Justin at OpenCorp and he can put you in touch with one of our investment brokers, at least point you in the right direction. But as Matt said, they can work through and look at some of the things that you can do that might be quick fixes to increase your borrowing capacity, like getting rid of expenses, so personal debts, credit cards, kids, those sort of things. So if we can reduce those, dependence might be a bit tough to reduce, but
It's like having a running coach, isn't it? Like you can go for a run on your own and sort of just plod along. You might have somebody who says, go and run 5Ks and time yourself. And then you got somebody who actually looks at how you run and what your technique is. And they're the ones who are going to take so much time off. If you're a runner, I'm a runner. So that's why look at it that way. And it's exactly the same in that broking space. You can get brokers who will get you a loan. You could go and do it yourself. But if you go to the right people that know how to structure it properly, they're the ones who are going to squeeze more efficiency out of your investment for you that ends up in like benefiting you in the long term.
Yeah.
And it's not always obvious things that you could see for yourself.
Yeah. A doctor's an analogy I assimilate to with, you've got someone who might be a doctor. Two people might be doctors. One's a foot doctor and one's an eye surgeon. You're not going to go to a foot doctor to get your eyes operated on. And that's the difference between brokers and investment brokers. So very good. Oh, look, I think people are obviously excited about the property market. I think we've covered a few different topics today, Matt. And so if people are excited about property, they're welcome to contact OpenCorp. We can point you in the right direction. You can utilise our services. If not, at least some of the information will keep you safe. But I think it's going to be a good year ahead for investing 2021.
Yeah, I mean, if you're excited about property, you can also just go to a barbecue and talk to everybody within earshot about your love for property. Just build the buzz. That's what it's all about. But then look, and I think as much as that's said tongue in cheek, because it's almost every barbecue I go to, there is a bit of property talk, and I try to avoid raising it because I live it and breathe it every day, and I don't want to.
Seem like a bricklicker.
Yeah, that's right. But the media and the attention that property gets, and particularly that it's getting right now, if on a weekly basis we're seeing dozens of favourable property market predictions coming out, whether they're from banks, economists, even just the person working in the copy room for the journalists are putting out their own predictions, and it's all positive. And that starts to feed through the market, and that creates a self-fulfilling prophecy as well. So as much as we don't take everything that's written for granted, the tone of the media and what's out there sets a tone.
Very true, very true. Always good to talk, Matt. We'll look forward to doing many more in the coming year.
Looking forward to it.
Cheers, buddy.
The information featured in this podcast is general in nature and may not be relevant to your personal situation. You should seek advice from a licensed professional before making any investment, insurance, tax, property, or financial planning decision. Guests appearing on this podcast may have a commercial relationship with the companies mentioned, and opinions and views expressed may not reflect those of the Smart Property Investment Network.